Good evening.
Hi, I'm Barry Erasmus, and this is Jose Nunez, and we are international tax attorneys with the law firm of Packman, Newell, Rosenberg in Miami, Florida. And the purpose of this video is to talk about an issue that we are seeing quite often in 2020, and that is when non-residents, and when we talk about non-residents, we are referring to people who are not U.S. citizens and not lawful permanent residents of the United States, who are spending more days than ever before here in the United States. And the risk with that is that if you spend one day too many, you can be subject to U.S. income tax with respect to your worldwide income. And possibly reasons for spending more days here than ever before have to do with coronavirus and border closures, travel restrictions, not feeling safe while traveling, or just overall feeling more safe or comfortable quarantining here in the United States. So when we go through this video, we're going to break it down into 3 topics. The first is the substantial presence test, which is how we calculate the general rules for determining presence here in the United States and taxation. The second is IRS Revenue Procedure 2020-20, which will exempt up to 60 days from being counted in that prior calculation. And third, we're going to talk about the closer connection to tax home exception, which is another exception to the general rule. And with that, I'll turn it over to Jose.
Thank you, Barry. So basically, yes, to begin with, this is not meant to be anything technical. We want to make it as short as we can, and we want to make it as informative as we can. But basically, our audience should be someone who is not a U.S. citizen and someone who doesn't have a so-called green card, meaning that this person was here as a tourist or was here with some sort of visa and normally would have been here with the intent of only spending a few days in the U.S. visiting, whether visiting family, whether visiting for tourism purposes. But because of what's happening in 2020, they basically got stuck in the U.S. So what can happen if you spend too many days in the US, like Barry said? You may have to not just pay income tax with respect to your income. Maybe your income isn't that great this year, but you will need to also tell us all about your assets that you have outside the US.
This is getting worse.
All about your bank accounts that you have outside the US, and pretty soon you're going to be spending, if not a lot of money in paying the tax, a lot of money in complying with these rules. So basically, what you basically started saying is that if you spend too many days in the US in any year, you could be resident for tax purposes. So what do you mean by too many days?
So I was referring to the general rule, which we refer to the substantial presence test, which basically says, well, it really determines, they say, how many days were you here this year and the 2 prior years, and they take a weighted average of those years. And based on the calculation, there's a magic number, and it says if you exceed this number, well, you're going to be treated as a resident alien for purposes of the US income tax rules. Well, for us, when we talk to clients, we say that magic number, if you're coming here on an annual basis, is 121. So if you come here every year, you could spend up to 121 days in the United States without exceeding that number and becoming a resident under this general rule.
Correct. So this magic number obviously is 121. It could be any number because there's a formula, but 121 is the most anyone can stay on an annual basis consistently and not violate the rule. The 121, it doesn't have to be consecutive. It can be 10 days in January, 10 days every month, and 10 days every month. That would be 120. So obviously that's also sort of like a magic number. But 121 is the magic number. But obviously 4 months. 4 months, we're now in the middle of October. The pandemic started, February, March. So there's people who have been stranded in the US maybe since February or March of this year. So by now we're already talking 7 to 8 months. So by now we're already talking 200 days, 210 days, 220 days. So anyway, so now tell us, Barry, about this 2020.
Right. So the IRS basically threw us all a lifeline. And they said in the beginning of the year that if you were here, non-residents were here, on or after February 1st and on or before April 1st, 2020, well then you could exclude up to 60 consecutive days from being counted as a day of presence here in the United States. So instead of that 121 magic number that we were talking about, at least for this current year, you can take it all the way up to 181.
Okay, good. So 181 days. So at least, I guess even though, I mean, obviously the IRS reacted rather fast and rather good. The issue was that this rule came out, I would say maybe in April, not later than May, I would say. By then, maybe they did not expect that this could take as long, but bottom line is that so far, even as recent as last week, they again mentioned that they do not plan to extend that period. So basically that would have only given you 181 days if you were religiously counting the 121. So what happens if you are now here more than 181? Unlike anybody who's been here since March, you are now in the 200-day mark.
Right.
What can you do?
So once you exceed that 6-month mark, that 181 days, then the next thing we could think about is the closer connection to tax home exception. And this test or exception is very facts and circumstances based. Basically, in order to meet it, you have to show that you have a tax home or a tax home with your foreign country, your home country. But what the principal element is that you cannot be present in the United States for more than 182 days.
In the current year.
In the current year, that's right. So, but when you're calculating that 182 days, we still get those free 60 days that was given to us in the IRS Revenue Procedure 2020-20. So that takes you from 182 to 242 days, which is a lot closer to the numbers that Jose was just talking about if you've been here since March or April.
So that's another good thing that, I guess these 60 days has given people. And basically, yes, so now if you can meet the conditions of the closer connection tax home exception, including the one that says that you cannot be here more than 182 in a normal year, 242 in 2020, then you should still be able to not be caught by the substantial presence test, and you could still be a non-resident from a U.S. income tax point of view, which is obviously much better than being a resident alien for income tax purposes. But okay, so now what can we do from now until year end if we don't have enough days to meet the 242 days? So what are the options, I guess, if you want to limit your stay to 242 days, but let's say your country is still closed, you cannot still travel to your country, it would be too hard to get back to your country. What are the options for people who still cannot go back to their countries?
Well, one of them probably more fun options, right? And if you're comfortable with it, if you're comfortable traveling, is leave. Right? You don't have to stay here, you don't have to go home, but you can leave the United States and maybe go somewhere on vacation, maybe go to the Bahamas, which is quite easy from here in Miami, just as an example. If you're up north Canada or Mexico, and you're actually talking about you can even go to Puerto Rico. And it's funny because for purposes of this rule, Puerto Rico isn't included as part of the United States for purposes of this rule. So that's why that's one of the possible destination.
Okay, so as long as you are not here more than 242 days, you could spend the rest of the year if you wanted to in Puerto Rico, and that would be also another way to not become a resident of the U.S. in 2020 for income tax purposes. So that's good. So now we have at least from 182 from 181 we went to 242, which is good. And so now what if you must, for whatever reason, spend more than 242 days in the US in 2020? What are your options then?
Well, first thing I'm going to tell you to do is call U.S. Tax Counsel. You can call us, you can call someone else, but you really should go talk to someone and see if your facts and circumstances warrant meeting any other available exceptions to excluding days of presence here in the United States. Another possibility is if you're from a country with which we have a treaty, a U.S. income tax treaty, because the provisions of the treaty may allow you to spend more days of presence here and not be treated as a resident for purposes of computing or calculating your U.S. income tax. So that can give you some additional flexibility. And finally, but from a treaty, just talking about treaty point of view, I guess unfortunately we don't have treaties with all the countries in the world, but we do have a good amount of treaties with several countries. Those that are close to the US include Canada, Mexico, and even Venezuela.
I guess the one with Chile is been pending for a while now. Obviously, when it comes to Europe, we have treaties with many of the European countries. We have treaties with Japan. We have treaties with Australia. So it's just a matter of, I guess, again, reaching out to counsel and seeing what options are available to avoid this status, or worst case scenario, you become a resident. It should only be a 1 year thing, obviously assuming that in 2021 you go back to your country. So, another option would be to obviously hire competent CPAs, competent tax counsel, and have them help you determine your income tax liability for 2020. And who knows, maybe 2020 wasn't as good of a year for some of us, and because of that, the income tax liability may not be that substantial either. But again, you are talking about a totally different ballgame if that happens to you. And with that, Barry, I guess you have anything?
No, I think we covered it all. Thank you so much for watching.
Thank you. Bye-bye.